This recording is an introduction to Chapter 9 in your textbook addressing long-term assets. So assets will have long lives, meaning more than a year. So it'll be around for more than a year. So here are typical things that happen to the asset. We acquire it, we're going to use it in the business, and then eventually we will, dispose of it in one way or another. So there are quite a few accounting issues for these long-term assets because they exist for a long period of time. Well, in this recording, we're going to look at about 2 or 3 of these. First off, let's look at when we acquire the asset. When we acquire the asset, we apply the cost principle. This is the same concept that we studied when we looked at merchandise inventory. So we want to capitalize, which means debit an asset, all the reasonable costs to acquire an asset and get it ready for its intended use. So if we look at a time chart down here, this represents when we actually start using the asset. Typically, all the costs up until that point are costs to both acquire the asset and get it ready for its intended purpose. So usually, all of those costs are going to create a cause us to debit the asset, and of course, credit cash or some sort of payable. Okay, so let's go to an illustration of applying this cost principle. So let's click on over to page 3. On page 3 in our little example, we have O'Brien Service Company purchased a copier on January 1, 2016 for $5,000 cash. They also paid an additional $220 cash for delivery charges. The supplier provided a $20 discount if paid in cash, and then O'Brien also purchased a 1-year insurance policy on the same day for $150. And then we also have information about residual or salvage value being $1,200. So what we want to first look at, up until the time we start using this copier, what were the costs involved? Well, there was a $5,000 cash payment, but actually we didn't pay cash of that. We paid $4,980, correct? So the purchase price of $5,000 less the discount of $20. And just like we saw with inventory, discounts reduce our cost. Okay, we also paid delivery charges of $220. So all of those are costs of both buying the equipment and getting it ready. Then we also have this insurance policy of $150. Well, that insurance policy really applies to when we're actually using the equipment. And so it is not going to be a cost of the copier itself. It's actually going to be a cost of when we start using the equipment. So let's go down to our requirements. First off, we are to compute the original cost and make journal entries. So let's make journal entries. So here's transaction number 1. Would be a debit to some sort of asset account. I'm just going to call it copier. We could have debited equipment, whatever we want to call the asset. So $4,980, and cash would have gone down $4,980. So we have really an asset exchange. We give up cash in exchange for the copier. We also had these delivery charges. We do not expense those. We capitalize those as part of the equipment, or in this case, part of the copier. So we increase the asset for that $220. And cash will go down as well. Okay, well, let's draw a T account over here for the copier, where it goes up with debits. And let's post our 2 entries. So our 2 debits to the copier account. Okay, so when everything is said and done, the copier has a cost of $5,200. And that is our goal in this account, is we are going to track the cost of the copier and maintain that. Okay, so that is how to record the cost of the equipment and how an accountant would calculate the cost for a long-term asset. All right, so we've gone through cost acquisition. Let's look at cost allocation. So as we use the asset, there will be declining value in that asset, or declining usefulness of the asset. So we want to depreciate the asset. So let's look at, what is depreciation? Depreciation is a cost allocation process. So we're just taking the cost of the asset and systematically and rationally match that cost with the time periods benefited. So we have seen before, this idea of taking cost out of an asset and moving those costs to an expense account. Let's take a picture of this. This is typically how I've shown this to you before. Cost in accounting can either be recorded as an asset or an expense. So what we're seeing is that when we acquire a long-term asset like this copier, we first put the cost in the copier or the equipment account, but as we use it, we're going to expense some of those costs as depreciation expense. So let's continue on with our demonstration problem and look at, well, how would I record depreciation expense on this asset? Well, as you may recall, we arrived at a total cost of $5,200. So I'm going to list that out. Now, usually, we're not going to use up all of the cost of a long-term asset. Like this copy machine, we're going to use it, but we're not going to use it till it just doesn't exist. Normally, a business won't do that. So we're going to estimate, how much will be, what sort of residual value will we actually have. And in the narrative, it tells us there's a residual value of $1,200. So salvage value or residual value is $1,200. So the actual cost we expect to consume or actually use is $4,000. Now, I also need to tell you that we are going to estimate the life of this copy machine to be 4 years. Now, that doesn't mean that's how long we think it will exist. That's the estimated useful life. So let's be specific here. And in this particular problem, I see I didn't really specify that when I wrote out the exercise. But let's stipulate that we anticipate we will use this copier 4 years, and then we're going to get another copy machine and replace it. Okay, so we expect to use it for 4 years. At the end of 4 years, we think we can sell it for $1,200. So we're just estimating the $1,200. So we want to figure out, well, what's going to be the depreciation? Well, there are a couple of ways of doing that. We've already seen the straight line method, and that's a really common method where we take the $4,000, the amount we expect to use, divide by 4 years, and that will give us $1,000 annually that we anticipate depreciating. So I'm just going to abbreviate depreciation. So every year end, we would make this adjusting journal entry. So this company, every year end, is going to make the standard entry for depreciation, debit depreciation expense, and instead of crediting the asset account, we create this contra account, accumulated depreciation. Now, typically an accountant will put together a depreciation schedule, and it looks something like this, where we have the original cost. Again, let me remind you, the original cost is $5,200. Now, when we acquire it, we don't have any accumulated depreciation. I'm just abbreviating that. So the book value, which is cost minus accumulated depreciation, the book value, which is the accounting value. The term book value it's just an old term. The accounting records used to actually be physical books, so that's where the term book value came to be. What's the value in the accounting books? So in the accounting records, we would have a net amount or a net book value of $5,200. Okay, that's at the beginning of the period. At the end of the period, we would make this journal entry. So we would have on the income statement $1,000 of depreciation expense, right? So at the end of the first year, we would depreciate $1,000. On the balance sheet, we would still have cost in the copy machine account, but accumulated depreciation would have grown to $1,000. So at the end of the year, cost minus accumulated, we would have a book value of $4,200. Now let's go and look at the book value. Let's go back to the T accounts, and we're going to post that $1,000 credit to accumulated depreciation. So here again, here's our asset. We're going to look at, actually we won't look at this one, but in a future date we're going to look at a different depreciation method. But for this lecture, we're just going to look at straight line. So if we had straight line, again, we started out with 0 at the very beginning. And then for 2016, we had a credit of 1,000. So again, at the end of 2016, we had a $1,000 balance. So at the end of 2016, we had a $1,000 balance. So what we would see in the accounting records and on the balance sheet is this asset of $5,200, accumulated depreciation of 1,000, and that's what I've put in here. Okay, so that's the end of 2016. Then a whole nother year goes by, and it's the end of 2017. So at the end of 2017, we make this journal entry all over again. Let's go post the accumulated depreciation. So we would post another $1,000. And now accumulated depreciation would grow to $2,000 at the end of 2017. So when we go to our balance sheet, now we'll have cost, stays the same, right? Notice nothing happens really. After we buy the coffee machine, usually this account just doesn't change, usually. So, well, it's that $5,200 stayed there. We have a $2,000 accumulated depreciation. Let's change that. So at the end of 2017, we expense another $1,000. The amount accumulated grows to $2,000. Nothing happened to cost. It stayed at $5,200. And now $5,200 minus $2,000 gives us a book value of $3,200. And then, you just keep doing that every year in. So now the end of 2018 rolls around. Again, we make this same journal entry. Let's go post the accumulated depreciation. And now accumulated grows to $3,000 at the end of 2018. So now on the balance sheet, we'll have cost of $5,200, accumulated depreciation of $3,000. So book value is $2,200 now. So that's what goes on the balance sheet. Again, we would have this entry, so depreciation expense is another $1,000 on the income statement. And then the fourth year rolls around, it's 2019. At the end of the year, again, we make this same journal entry all over again. Let's go post the credit to accumulated depreciation. And now it has grown to $4,000 at the end of December 31st, 2019. December 31st, 2019. So now on the balance sheet, we have cost of $5,200, accumulated of $4,000. So cost did not change. Notice it's always $5,200, but the amount accumulated for depreciation will always grow. And now we have a book value of $1,200. Also keep in mind, we would have depreciated or expensed another $1,000 on the income statement. Okay, so let's look at some big picture stuff then. Over the life of the asset, total depreciation expense is going to total $4,000, which is the amount we have accumulated, right? So that should always equal. So if I add up all my income statements and depreciation expense on the income statement, I'll get $4,000. Another interesting thing or notable thing is the ending book value. This ending book value should always equal our salvage value. So we estimated the value of the equipment, or the copy machine in this case, would be $1,200 at the end of its useful life, and that's exactly what we have, $1,200. So that should always work out that way. Okay, so there's the big picture. Now I also want to point out we had $1,000 each year. So let's go back to our page that shows depreciation, I'm going to go ahead and we're going to visually look at over the 4 years, the dollar amount of depreciation expense. It was always $1,000. And so, not that I can draw a straight line, but theoretically that's supposed to be a straight line. That's where this name straight line comes into play. It literally is just a straight line across the board, across the years, $1,000. Okay, so we've looked at the original cost when we acquire the asset. We've looked at cost allocation. And then the third thing for this lecture, we're going to look at expenditures after acquisition. So what do we do? Because we're going to spend money, right? On the, we probably will have some repairs. There's typical maintenance, like especially if we had automobiles, right? You change the oil, that kind of thing to maintain the automobile. So what do we do with those costs? And this is where this idea of, again, the issue of cost in accounting. So these costs that occur after we acquired the asset and we start using it, what do we do with these costs? Well, the answer to that is applying this principle. Identify, does the cost have future economic benefit, meaning we haven't consumed it yet? If so, we'll capitalize it as an asset. If the cost has been consumed or it will be consumed very shortly, we go ahead and expense it. So let's go look at a demonstration problem. Actually, let me stop off here before we actually get to the application. Here's a nice little chart that kind of goes through and telling the accounting treatment, whether the debit is to an expense account or whether the debit is to an asset and we capitalize the cost as an asset. So if the cost, is just ordinary repairs or maintenance that does not have a long-term benefit, and again, recall the cutoff for long-term is more than a year. So if it doesn't have any long-term benefit, we expense it immediately. And most normal maintenance costs are going to be expensed. Now, it could be that we have some sort of repair that has a long-term benefit. So, for instance, if you overhaul the engine in an automobile, that overhaul will, give you several more years life out of that automobile. So we would capitalize that. Or if we have an addition, so if we add on something, if we have a building and we add on to that, we would debit an asset for those costs. So let's look at an example here. So we have the following maintenance and repairs. So in 2016, we just have normal reoccurring maintenance. And if this had been an automobile, that would be things, again, like, changing your oil and that sort of thing. When we have normal recurring maintenance that has a short-term benefit, you can see we just debit the expense account and credit cash. So I've gone through all of those that are just normal and they frequently occur. We just expense those. Now, there are a couple here, though, that is not the case. So in 2018, at the beginning, we purchased an upgrade package from the copy manufacturer that will double the production capability or capacity. So in other words, we're going to get more benefits, right? This is going to increase our benefits from the copy machine, right? We're going to get more value out of it. So it's going to be more beneficial. So in that case, I'm going to debit the asset copier. It increased its cost at $1,000. And cash will go out for that. Okay, so again, it's going to increase our long-term benefits. And then the other one happened at the beginning of 2019. Purchase an upgrade package. It's going to extend the life. Instead of 4 years, we'll use it now another 2 years. So again, it's extending the life. It's extending our benefit of the copy, the benefits that we're going to receive from the copy machine. So it extends the life, If you extend the life, you're going to get more benefit out of this piece of equipment. So here again, we capitalize that by debiting the asset account. Cash will go down. Okay, and that concludes this particular lecture. So you'll be able to go to Wiley Plus, and you're going to have, again, homework will address cost allocation using the straight line method, and subsequent expenditures on the asset. You can see we've got more topics to cover, and we'll look at that next class period.